Welcome to the New Barbarians podcast. I'm Bill Mann.
And I'm Mark Connors, and we're here to deliver insights on how current macro trends and market events have changed the value proposition on traditional assets like equities and bonds, the things Bill and I grew up trading, investing, and researching over the last 25, 30 years. Instead, we think it's digital assets that are setting the new financial and investment frontier for investors like you going forward.
We're also here to explain how cutting-edge tools like AI and disruptive tech are the new barbarians at the TradFi gate.
So hit the subscribe button on your favorite podcast platform, and let's cut through the noise together.
Welcome to episode 9 of the New Barbarians podcast. Today is Friday, February 21st, 2025. This podcast will hit the platforms on Monday, February 24th. Today we'll go through our usual updates where Mark Connors provides context for the first 30 days of Trump's presidency. A month ago, we created the soundbite, Economic Investing Outlooks Balance the Promise of Trump's Policy Changes Against the Backdrop of Debt, Deficits, and Demographics. Now that we're in a stage where boomers are retiring, we have, very different
That's not us, though,
demographics.
Bill, right? We're not boomers.
It is not us. Thank you for bringing that up, Mark. Boomers are those who were born between 1946 and 1963, and they are now retiring, so they're no longer going to contribute to the workforce and GDP, and therefore our demographics, given how heavily weighted we are to the older generation, should suffer in terms of, I think, GDP growth in particular, but some of that's offset by all of the advancements in technology, et cetera.
Yep. And
with that, I will let you take it away.
All right. Well, I'd be remiss not to talk about last night's hockey match. I say match because I'm a rugby fan. The hockey game. It was every other sport is infantilizing their all-star break or the Pro Bowl. The NFL basically, I wrote something about how the NFL is basically like a middle school field day now with, former players kicking field goals. And then you had the NHL bring out this, I don't know if anyone caught it last night, but this 4-nation face-off. I mean, out of nowhere, instead of having people retire and, and do slap shots from mid-ice to entertain, these folks went after it. And I think the reason I'm bringing it up, besides it just being fun, is that there are different ways of approaching things. And right now, as you said, we have an aging demographic, we have slow growth, we have a lot of debt, and people can keep going to the easy game of trying to get eyeballs by doing like a fan favorite event like the NFL, just living off their brand, or you can innovate. Hockey does not enjoy the NFL's brand license or their contracts, so they had to get people to commit and play the longer game. And so that's kind of what we're doing here. We're innovators. That's why we're the new barbarians. People don't understand our language. And I mentioned it because right front and center, last night's, that whole thing was out of nowhere. It was like a recommitment by professional athletes to deliver product. And it was just phenomenal.
So, I hate to interrupt you, Mark, but who won?
Oh, Canada.
I did notice that. I turned it on before the half and then watched the third period.
Yep. Great match. We brought it with the 9 seconds of 3 fights on February 12th to kick it off. People said it was tariff related, had nothing to do with tariffs. These guys just like to fight and get it on. It's just so funny. So pulling it back to the promise of policy versus reality, I'd like to look at returns because we made a bold statement, and it's not just a bold statement, it's something that I think is going to stand the test of time. policy takes a lot of time to roll out. And we saw Scott Bessent speak yesterday and say, hey, listen, the gold's there. The fact that he has to say the gold's in Fort Knox is odd. And the reason he had to say that is because gold is up 45% in the last year. The last time we saw that was in 1979 when we had inflation running rampant and we had low growth and negative growth. It was a tough time. So there's definitely uncertainty in the marketplace. And Scott Bessent took center stage on Bloomberg to say, hey, listen, calm down. It's almost like the guy in what was the college movie with John Belushi back in the day?
Animal House.
Animal House, where Kevin Bacon is there saying, stay calm, all is well, and he gets run over.
Yeah.
So that's kind of what I'm thinking was what some of these policy folks are saying by saying the gold's there. And he also said very importantly to the market, and what Kevin Jang, our guest in the last podcast, said, we have $10 trillion of debt coming due in the next 12 months. Actually, it's a little more than 10. But don't worry. I'm not going to put it out in the long end where there are no buyers, where it's like a ghost town of investors. I'm going to roll it just like the previous administration did in the easy-to-eat, sugar-coated T-bill land where everyone gets 4.5% and is happy and can have a 3-month risk, because that's where the appetite is. And there are just more buyers in the front end.
So is part of Bessent's job to sort of rally people and drum up interest in the markets and make people come?
And I think you might be you might have heard, but Jonathan Ferro and Bloomberg called him America's #1 or top bond salesman, like going back to Bonfire the Vannies, 1980s, Salomon Brothers days.
Well, yeah, and I guess we can even get into the title of our podcast, which harkens to that. But I was actually just going to say, I guess Bessent seems like the type that wouldn't give up after the Germans bombed Pearl Harbor as well.
He wouldn't. Thank you for the follow-up. Another reference, folks, to Animal House. And I think Bessent's first public appearance on a major traditional channel where he did two things. I think he did three. Let me see. He definitely did two. He said, gold's there, don't worry, because people, there hasn't been an audit of Fort Knox. God, just not even talk about that one, how that can go sideways. And then he said, I'm not going to push stuff out the curve. And I think that was a big deal. Calm markets a bit. As you said before the call, Bill, that the 10-year has tightened a bit after spiking, 100 basis points between September and end of the year in 24. So I think people are giving him a little bit of credit here, saying, okay, we're not going to be issuing, long-term debt. But he hasn't really answered, are we going to stop being a deficit spender? How are we not going to issue overspend by another $2.5 trillion? So on the macro front, our theme has been, like you said, can new policy give us enough growth to grow out of our debt cycle? We have over 125% debt to GDP. To put that in perspective to our lay people, imagine if you made $100,000 a year and you had a credit card debt due of $125,000, and your interest expense was going up, as ours is, because we're rolling out of low coupon debt. How would you feel? It's not a great place to be. So I think you mentioned, if you didn't, I'll mention it anyway, my Substack called Mind the Gap, which is speaking to the gap between wage earners and asset owners. And I'm going to touch on that. What we saw in 2020, I think we all lived it and saw it. People who had service jobs in finance or lawyers who could still operate by Zoom, they noticed they weren't going out as much. They weren't spending money, but their stock portfolio was going up and their income mostly stayed the same. So they were increasing their wealth during COVID. Maybe you're losing your mind, but you were getting wealthier. But the person who was a wage earner, someone who had to go in and work in a restaurant, they didn't have a stock portfolio and they were losing their wages. So you had this K recovery, which got a lot of popular press. That is alive and well. That is the investment thesis for the next 10 years, and something I'd like to dive into right now, if it's okay. I know we're running on time here, but I'm going to hit this, speaking to Chris Rose, our engineer and analyst. I'm going to go on my screen and go over a few returns, and then I'd like to hit our slides before I go back to Bill. All right, I'm not a boomer. I can share my screen. All right, entire
Okay,
screen.
boomer.
And there we go. Yeah, proof is in the pudding. Get a penalty for the time lag there. All right, so one of the biggest events after COVID was obviously the rate hike in March to December of 22. And that split assets in half. Assets that benefited from inflation that still persisted eventually did better, and assets that don't do well during inflation did not do well. So look at this. You have a mess and a maggle of looking at, I'll tell you the assets you're looking at. You're looking at gold in the form of gold denominated in dollars. You're looking at NASDAQ, ticker CCMP. You're looking at T-bills, which is the front end of the curve, just 3 months to 1 year bills. You're looking at 7 to 10 year treasuries, and you're looking at oil. So the growth trajectory, oil is impacted up and down, didn't really move, down 20% actually over that period. Safe haven bonds out 7 to 10 years are down 9%. That's one reason, Bill, why we saw all those banks fail, is because they had levered treasuries that went down as much as 50% on the long end. So we're still seeing that. So that's why Scott Bessent said, don't worry, we're not going to put any more of that long duration paper in your portfolio. We're going to keep it really front loaded so that you can buy our bills that are in the green. That's why he said it, because we don't know the trajectory of inflation right now. We don't have a handle on it. Growth is lower for sure, but again, inflation is not in check, as we found out last week. But look up here. NASDAQ, that's trading at all-time high multiples. Gold is trading at all-time highs. Now, that's over a 3-year basis. Let's look at over 5 years. You have a pattern that's similar. NASDAQ did better than gold. And the point is that's flipping because now people have moved into gold more recently, as you'll see in the 1 year chart, front and center, where now NASDAQ is lagging by a fair degree the yellow metal, which is unusual. People don't even know what gold was used for, et cetera. So we bring that up because the underperformance of bonds requires someone like Scott Bessent to come to the fore and be the world's #1 bond salesman. Or as you said, he won't give up even when the Germans bombed Pearl Harbor. He'll keep trying to sell the long end eventually. He tries to, so there's a gambit and it's long running. I guess, Chris, if you're able to show the slides now, I kind of want to go to this dynamic that we have, and I'll stop sharing, where we have so much debt. Back to the analogy, if you had 125 grand of credit card debt, if someone said, do you want to go to the movies or even go out to Chick-fil-A, you might think twice. Everything is focused on that pile of debt and that coupon interest that you got to pay every month or every quarter. That's where we are. And when we look at our slides, I'll kind of show you what the government's been doing in order to keep things going despite the growing interest rate. So here's where we are. When everyone talks about history and about Volcker, and he raised rates, he slayed inflation, good for him. When Volcker did that in 79 and 80, we had 30% debt to GDP. He had a very low, small credit card profile. debt load. He could do it. We can't do it. That's why Besson is going to do his level best to do what some people call the Mar-a-Lago Accord with Trump and get people to lower the strength of the dollar. That's job one. Lower dollar means lower interest rates, and it means that there's lower interest rate expense, and the U.S. has a better trade balance where we can get more, increase our GDP by having better trade, where manufacturing is more attractive because of our lower currency versus others. Lower dollar is job one. So he needs to sell bonds, and he needs to lower our dollar, and those two things have to happen. We'll talk about that for the next 12 months. If you can go to the next slide, please, Chris. So remember I showed you that K recovery we talked about in wages? Well, here we have an example of how life used to happen between the 1980s, 1990s, and 2000s. You had growth, GDP would go up, equities would go up, the money supply would go up a little bit, 5 to 6% a year. And then people would get all, animal spirits would take over. We'd have a bubble in the market, and then we'd have defaults, things would crash. And lo and behold, you could reset and buy assets where they were maybe 5-10 years ago. Happened in 2002, happened in 2008. It will never happen again. It won't happen again because now you don't have the debt load at companies that can go through bankruptcy and reapportion. The debt load is now at the U.S. government. It's at the UK. It's on Japan's balance sheet. In 2008, all the governments came in and bailed out the banks to a degree where the word trillion was used for the first time in finance.
This chart also, sorry to interrupt, this chart also does remind me of, since 2009, bad news for the economy is good news for equities and in all assets. It's very interesting to see how this line almost returned to normal in January of 2009, but it's also kind of like the price of housing, that supposedly corrected and I know values and, forget about inflation are way above where they were during that real estate bubble. But yeah, the asset bubble, I think, is permanently higher. I just, wonder when we get into some like Minsky type of moment.
Yep.
Because that's crazy. And I also, the previous chart is showing that we've been above the World War II for, ratio of debt to GDP for a couple of years now. And I guess that's a permanent thing.
And who are we fighting, Bill? Like we're fighting Canadians now?
Well, yeah, I mean, I suppose we may be involved in some conflicts, but certainly that's a striking chart, the debt to GDP one that,
It is. And
getting back to the Bonfire of the Vanities, the Tom Wolfe book and then movie, where are we versus the early Reagan years? It seems like from just that measure alone, I remember people thinking that, Reagan was a big spender and, fiscally things were good. But I remember, people looking back and saying, Reagan was bad for the deficit and for debt. But compared to now, it's like,
it's off the charts. And if we go to the next slide, we can see that. I wrote something called It's Morning Again in America, which was Reagan's re-election speech or campaign that he put out there in 1983 and 84. And I've made the analogy to what's going on now. When that 84 campaign was put out there, talking about low inflation, family formation, again, look what he did. And, blow up your screen if you can't see it. there were two recessions in the early 80s back to back, and they were rather pernicious, related to the S&L crisis. And the good news is, though, Reagan kind of blamed the prior administrations and all that, but he had a reset through recessions for growth to happen. And those families could form because they could afford houses, just like what you said, Bill. If you look at the number of recessions since those two in the early 80s, they basically have become fewer. And I hope this chart really makes it mainstream. It's a St. Louis Fed chart. And I think that it's not for free. People are like, good, no recessions, jobs get to keep going along. People don't lose work, that's good. I said, yes, but there's a cost to it. The U.S. is funding the scarcity of recession through deficit spending. You can see it. The blue line is our deficit as a function of GDP. Even though we're in peacetime, even though we have fewer recessions, well, if everything's so good, why are we spending money? And to even give this a bit, to show the starkness of this, in the next slide, thanks, Chris, we break out three periods. We break out that Ronald Reagan, It's Morning Again in America kickoff in 84 until today. Then we look at the prior 40 years, which include post-war and everything in between up until 83. And then we look at 1900 to 1942. As you see, there were 9 and 10 recessions in those two 40-year periods, prior to 84. And the number of months in recession average, I think, 26, 27%, 25% or so of the time that you were alive between 1902 and 1983, you spent a quarter of your life in recession. If you were born in 1984, you spent 7% of your life in recession, just 36 months, and only four recessions.
What about if you were born in the 2000s? Like my grandmother had to drop out of elementary school in the Depression, and then my parents, now that I'm looking at this, spent a fair amount of time with recessions, and I at least remember them. But like that 2021 was de minimis. It was non-existent, really. No one lost their jobs. Everyone got paid by the government.
And Bill, you and I, I won't dox where you live, but we're in Westchester and Fairfield counties. We didn't lose our jobs, but people in the service industry did. That was the first recession that was almost tactical in who it hit. Whereas in 2008, a lot of people lost it because I always get them wrong because I always forget. Lehman went bankrupt. Bear Stearns didn't. There was destruction of value in the housing went down for a bit. It was a bit of a longer duration. It was a bit of a normal one, more financial.
I think. Sorry to interrupt again, but Bear Stearns went insolvent and was taken over with the government's assistance.
Nice.
And then the government decided that Lehman was the one to allow to go bankrupt, and then no one else was allowed to go bankrupt after that.
Huge distinction, and that's why I like having you on here, because points like that land the plane on who's in charge. And the business cycle is now in perma freeze, where it cannot go below zero because we need to keep people employed. And I guess, can we go to the next chart? I forget which one is good. Thank you for this, Chris. So when we look at what are we spending money on as a government, the top thing we're spending on is Department of Health. It's Medicare, Medicaid, and other. When you look at jobs and the fact that we have a 4% unemployment down from 4.1% unemployment, over a third of those jobs came from the healthcare industry. Some directly, but mostly indirectly subsidized through government processes and programs. And then the third one is interest expense. paid by the Department of Treasury, which is going to go up as some of this low-cost debt rolls down. So our cost structure is untenable as people get older, back to the top of the story, and their healthcare needs increase. I think something like 90% of your healthcare needs occur in the last year of your life. So you talk about hockey stick trajectory of cost, and our government spending is not capped. It is open, meaning that it is a defined benefit regardless of cost, not a defined contribution of dollars that is paid to you to figure out how to pay for it. Big difference, a lot of gobbledygook, but I think that's it for our slides. And really what I wanted to say is going forward, all the policy is going to talk about promises of growth. And Besson said it. We're going to lower energy costs. God knows if that's why we're talking to Russia. We're going to be increasing growth also through less regulation. And you're seeing that by this morning. Coinbase said that the SEC is going to drop their lawsuit against them. So I do think that regulations be much more business friendly. They have to unleash the banks for better or for worse in order to make money looser, better, faster, in order to get GDP up. That's definitely going to happen. I still think all those names that we saw on our screen that were going up versus down, that all benefits them. All that money will be directed into large cap equities, gold, and Bitcoin.
Hey guys, if you got anything out of that last segment, don't forget to like, comment, and subscribe. It really helps us grow the podcast and bring you great content. Thanks for the support. Thank you, Mark. I do think that, the safe haven assets are performing well, and so are quality stocks. And I think there is a general market sentiment that's cautious, if not a little scared. And I don't know where crypto is right now. I'm trying not to watch over the last couple weeks. I enjoyed talking about it a lot more in the prior month. But I tend to agree, especially to the extent that Bitcoin in particular is, the digital gold, and it should behave appropriately if it's more of a safe haven asset, and I have to say that slowly and deliberately. So, clearly I'm still too emotional to, have that sort of conviction, but I do believe. I'll just kind of wrap that up. Paranoid.
Yep. And the market agrees with you because Bitcoin dominance is a measure of how much Bitcoin is market cap versus the rest of the crypto universe. And it's been going straight up since the bottom in 22. It's now up to 60% of the entire market cap is Bitcoin. Which means that animal spirits and digital assets are not there. People are expecting an alt season to come in. We've had flurries of it, but that's still there. So I agree. I think we have a cautious optimism at best, Bill. But is there anything that you see that through some of your factors or the work you're doing?
Well, I guess just to finish the thought on the crypto thing, it seems like we do have some history to work with. These prior cycles, and Bitcoin leading and then other ones lagging, and everything we do in quantitative research is, pretty much everything we do is based on some historical analysis and the expectation that things will repeat. And there are concepts of like this time is different and things like that are almost in the parlance of the TradFi world. But I'm still confident that this cycle and the macro cycle have this relationship. It's just an interesting time, and this a month these days can seem like a long time, including when I look at my recommendations for a quant tactical portfolio that was, meant to express a view on the Trump trade. And, some of that was just continuing what happened at the end of 2024. And I think we've seen some deviations from those, early patterns already. So and then specifically trying to reflect on everything you covered, which is complex, and there are so many moving pieces. There's policy, there are individuals who I think say things on TV, and markets react, and there are just many moving parts. So from a quantitative perspective, it's complex to build a model that takes a top-down approach from all of this macro data. And I think there's plenty of research on Fed policy changes and in particular shocks. So I think that those are discrete things that you can kind of study, but they generally behave as expected. So lower interest rates and easing monetary policy is good for assets, all assets, and in particular the riskier ones. So to the extent that I can distill things to that like one dimension, I feel pretty comfortable about saying, yeah, we should be bullish, and that was in fact my tactical outlook. But then, like any human, I start like looking around, and there's a bit of a, I don't want to ever make analogies to like wars or being shell shocked or anything like that, but I did spend 2 years at AIG when we were just talking about financial institutions that either went bankrupt or did not, or either went insolvent or not, and that was like really like a 2-year slow dying situation, so like by the time Bear went down, I was like, oh yeah, this has been taking forever. And then it was like a whole nother year of that. Anyway, I guess that's definitely a digression into my own fears and emotional way of looking at the market, which is why I got out. Like I wanted to just step away and have machines help me make decisions, and to base things on statistical probabilities, and just to take the emotion out. And then here I am like going on and on about how emotional I am. Thankfully I'm not pulling the trigger on any investments as a result of CNBC headlines and stuff like that.
Yeah. I call it like being, is it Odysseus, lashing myself to the mast as the sirens call me to the rocks.
Actually, that is from the Odyssey.
Hey guys, if you got anything out of that last segment, don't forget to like, comment, and subscribe, as it really helps us grow the podcast and bring you great content. Thanks for the support.
That's right.
So you definitely need that discipline, and what you're doing and what we're all doing here is unique, and it's a great opportunity. I talked to a friend of mine, and a former client when I was at Credit Suisse, who's on the credit side, really well steeped, understands macro, has a great business. And I told him what I'm doing. He goes, wow, that's great. I wish I had the time to really step back and review everything. Because he's like, it's needed. Like, we're in a unique period. And the problem with finance is that it's so complex, as you said. And we invite all readers to go to our Substacks or just ring us up. I'd be happy to spend some time on the phone or an email exchange going over some of these ideas. They're so complex that if you are head of a structured credit group or a listed options team, that's all you do. Besides the regulatory and the training you have to do to keep up with regulations on money laundering and all that stuff, you have 8 different jobs just to make sure that you're in compliance, that you're commercial, and that you're trying to meet that quarterly number. You have no time to go over what we just talked about debt demographics. Like, that's a luxury. So I don't know if that is what you're alluding to about, stepping away. But that's one reason why
I think absolutely. And that's, one of the benefits of quants is like, there was never a CNBC TV on at my previous firms. And if there was, it was like people ignored it. And I actually like, yeah, the lack of interest in what's happening on a day-to-day basis is striking compared to your traditional financial institution. And, I did have plenty of things to talk about in terms of the quantitative positioning and like, I'll just quickly try and rattle off a few of our updates since we're running out of time. Macro sensitivity factors have actually been doing pretty well. So, if you invest in things that react to the news and to these different policy changes and Trump, we almost need a new term for all things that can happen with this new regime. But yeah, AI exposure's still doing well. Sensitivity and inflation did badly because inflation's up. And then, high frequency quantitative strategies have been doing well because, again, they're very reactionary. So to the extent that your models can react to either market information or news, like, they're going to do well. Reversal has done well. In particular, we had that huge sell-off with DeepSeek's news in late January. And so, you can just look at NVIDIA. So NVIDIA's strong upward momentum was reversed in a day. So that's very good for those stocks. What else? Growth has been doing well, which is kind of an offset.
Bill, I'm going to go back on the DeepSeek because that's such a great use case. And my son actually asked me, he goes, "Dad, should I buy NVIDIA here?" It was down, I think, 16% at that point. Yeah. I'm not a trader, so I gave him the wrong advice. He should talk to you. But so how would your model have said on the macro front, there's a reversion from a mean, is it a green light or red light?
Yeah, so and we've touched on this a little bit in the past, but basically you look at the statistical significance of a move, and you measure that in standard deviation space, which we refer to as sigmas. So I don't recall what the sigma move was for NVIDIA, but it was probably like 5. And in the probability world, a one-day move 16% down when it's been trending up is kind of like the moon crashing into the earth in a single day without any advance warning. So yeah, it's probably a good buy signal, as long as you take the emotion out of it. Like, of course it could keep going down, and the news headlines on that day and going forward would be like, the world is ending because AI in the US is dead, and that's what's been driving the economy. And so, everyone should go buy Twinkies and guns because, if you haven't prepped yet, you need to prep when DeepSeek, has this headline. So I hope that answers your question. It's really like, especially from a tactical perspective, I think we usually just look at like, how significant is this? Is this something that we can expect to repeat, especially in a single day? The answer is no, certainly from a historical statistical perspective. But yeah, I would love to actually do more of a deep dive on that sort of thing. And we can probably do that maybe even with our research and then talk about it some more.
Why don't you finish up on what the last part? Because I think we spent a lot of time talking about about what's going on now and why it's relevant to take a step back. But you have some research that you've done that speaks to it that people should definitely hit up and that you're going to do.
Yep. So yeah, just to kind of wrap up the quant backdrop, like my tactical asset allocation portfolio that was kind of based on, it was really just based on a synthesis of Wall Street outlooks, has been sort of lackluster. The big change, the big surprise really was just equities in Europe outperforming. That was not something that we forecasted. And interestingly, when I looked at it, those weren't very significant moves from a statistical significance perspective. So they were huge moves in return space, but not very huge in the sigma space. And I think that that's just because it's been a very steady, slow creep throughout January and into February. I actually haven't looked recently, but it's been a interesting change, and I think it's just overall risk sentiment, and behavior is driven by the risk trade more or less. But I think people are still taking on risk. They're buying equities. They're just buying safe equities.
Mm-hmm. Got it. Is there anything that's coming up? We've talked a lot about equities, but we haven't really touched on credit that much.
Yeah. So I have a research agenda that I try and set out ahead of time when, for the year. So I actually I wanted to talk about credit because I do think when we get into this debt cycle, it used to actually be the most important thing to think about. But next month in March, I think we're going to be focused on bonds and interest rates and sort of this overall macro quant investing research. And then in the following month in April, I do want to talk about credit, and maybe we can finally talk to me about. It was funny, you had Maiden Lane on one of those slides, and Maiden Lane always makes me think about Thanksgiving of 2008, when I spent the weekend working with the New York Federal Reserve to try and take all of the assets out of the banks, backdoor bailout them through AIG, and put them into SPVs that were known as Maiden Lane 2 and 3. I think Maiden Lane 1 was Bear Stearns, and then 2 and 3 were AIG. But now that it's been 17, going on 17 years, I think I can talk about that a little more freely. At the time, I did not want to talk to anyone about it, nor could I. But so we will definitely talk about credit and do some more research and publish on the topic in
Awesome. April. All right. Any takeaways for the folks to look at?
I'm not going to look at charts or things that make me nervous. I'm going to do what I say I do and just, stick with the rules-based, emotionless investing that I tell everyone else to do.
Nice. And I would suggest the same. I think everyone should get their own process, and being an inch deep and a mile wide might work in a cocktail party, but it's not good advice for running a portfolio.
Cool. Well, I think that then we can wrap it up for today, and everyone enjoy their week. You'll listen to this on Monday.
Thanks a lot. Take care, everybody.